Welcome back, investors, to Ticker Time News. I'm Adam, and if we do indeed get this new paradigm shift tomorrow, it will completely change the way traders need to think about or even interact with those correlations. More on this in just a moment. Now, following yesterday's humongous rally, there wasn't much up or down price action for the stock market after some mild turbulence coming out of the gate this morning. Nevertheless, it was a pretty good day for the bulls since sellers were reluctant to undo yesterday's gains. There might have even also been an element of trepidation in today's trade as participants await the November employment status report tomorrow at 8:30 a.m. Eastern. Now, market participants were contending with the idea that they might have to or they may have overreacted yesterday, and that the growth environment is going to be challenging given the past rate hikes and the rate hikes that are yet to come. We're not done with rate hikes yet. I don't know why the market seems to be cheering that they are. They are not. There will be a slowdown, and rates will continue to go up, possibly 5% or higher, and then be held there for a long period of time. Now, a 49% reading in the November ISM Manufacturing Index today. And remember, 50% is the dividing line between expansion and contraction, meaning manufacturing activity has contracted for the first time since May of 2020, demonstrating that the incremental effect of rate hikes around the globe is adversely impacting demand, while at the same time curtailing inflation pressures. This also took some steam out of the upside momentum in the market today. Now, let's hop over here to the other chart. But actually, first, real quick, before we do, look at the heat map today. 50-50 across the board. We hardly moved by the end of the day. There was some gray. Look at Microsoft, down 0.2%. Amazon was down a whole percentage point, but you see a lot of gray. Gray means they hardly moved at all, like 0.2%, either way, up or down or less, right? So a lot of gray, meaning a lot of uncertainty. Not a lot of fear because we'd see more red, but uncertainty about this paradigm shift that we could be seeing. Now, let's hop over here real quick. I want to pull the 10-year up, the 10-year yield. Now, the 2-year yield, it fell 15 basis points today to 4.23%. In the 10-year, it fell 17 basis points to 3.53%. You can see it's sitting there right now, 3.539%. Look at this. It is going down, a falling wedge, if you might. And let me pull up the chart pattern here. Where do we see a falling wedge? Well, typically when price action is going down, right? Price action rose, and then we had a falling wedge. Where do we see that at? Where do we see that? We see it right here. Right here. Okay? Price rose, price fell, and we get a falling wedge. You could look at it as a falling wedge. You may also look at it as a potential falling wedge over here. Okay? It all depends on the tail of the thing. Now, if I pull this up with my highlighter here and show you, we were rising, right? And now we are definitely in a decline. We are moving down, but we are also wedging. So up and then a falling wedge. Let me pull that chart up again. Does it look like the top falling wedge right here, which would be a reversal? Or does it look more like this falling wedge right here, about the middle of the screen on the left, where it's a continuation pattern, meaning that we went up, we're in this big falling wedge, and maybe we're going to bounce and go higher? Something to think about, okay? And this one can be, well, it can be determined either way. You can see it either way if you want to, okay? I see it more towards a continuation pattern. However, if there is growth concerns in the market, then this may not continue and move higher. This may continue to fall. Now, something else outside of the 10 and 2 falling significantly, double-digit points today, TLT. Let me pull that up. This is your long-term TL, not TH. TLT, okay? This is your longer term. I forgot to click a button over here. All right, we're back. This is your longer term treasury bond, TLT. That's the ticker symbol. This thing ignited nearly 3% today, and it has been in this potentially forming channel. I know it's not really technically a channel yet. Why? Because when we are setting up these chart patterns, and this goes back to November the 7th when this started, or you can potentially go back to maybe November the 3rd. Let's just call it the month of November. TLT has been on fire. Now, the reason I can't call this a channel yet is because whenever you are drawing trend lines on your chart, all right, you need to have 3 contact points or more for it to be considered a trend line. And right now, we only have 2 on the bottom, there and there, and we only have 2 on the top, there and there, for the month of December. So we don't have a confirmed channel yet, but one more touch of either of these lines here, and we will have it confirmed. Now, if we just take a step back for a moment, where has this come from? Where has TLT fallen from? TLT has fallen significantly this year, okay? Now, let me put the 10-year up here for just a quick second. What has the 10-year been doing this year? It's been rising. Just recently, like maybe the month of November, has it been falling? But what about TLT? Let's put this on reverse. So we have a negative correlation here with the 10-year yield. When the 10-year yield is going up and making strong moves, what does the bond yield, or what does the bond here do? It goes down. So this little rally that we have here in November is important because the 10-year has been falling in November while the TLT has been rising in November. Now, if I do this, let me get this trend line. I'm going to attach it here at the top, which would be December the 6th of 2021. And I'm going to run it down here, and I'm going to capture the highs of 2022. Let me line it up. There it is. Okay. Let me do one more thing. Let me do one more thing here. I want to remove these highlighted spots here because I want to show you something. I want to show you why this is important. This move here in November for the TLT, why it's important. One more to go. Okay, gone. Now, this trend line going down, this has, oh, what did I do that for? That's not what I meant to do. This trend line going down from December of 2021, I need to put a red on that because it has stopped any rally in the TLT for the entirety of 2022. Okay, everyone, it has stopped. Look at this, right? We get it started up here in December of 21. Here in March of 22, it gets rejected. August of 22, it gets rejected. What just happened right here for TLT? Let's move in. Let's move in and get a better look here. What has it done? What has it done? I want to open it up so we can see it. This is TLT. This is your long-term treasury bond here. Let me open this up. Look at this. What has it done? It fiddled around with the top, with that trend line, okay? That down sloping trend line. It fiddled around. It was resistance, right? And then it spent a day over it, right? And then it came right back down the next day. It was resistance again. But today it pulled above that downsloping trend line with force. Why can I say that with force? Because look at the volume. Volume is down here, okay? This volume profile, I got to raise it up a little bit more so you can see it better. Look at the volume down here. This is incredible. Incredible. Right here. Boom. All the way up there. We had, what was the volume right here? 53.1 million trades today. What's the average? What's the average? The average is only 22.2 million. Double the amount of volume, a big nearly 3% move in TLT. This is a big breakout. If this gets back tested and it holds, this is a paradigm shift for TLT. Now, let me show you something else, okay? This is important. Sector rotation. When are things going up? When are things going down in the cycle of the markets and in business, okay? For the past quarter, I have been thinking that we are right here on the business cycle. We are in the 6th stage of the business cycle, right there. What happens? Bonds go down, stocks go down, commodities go down. What goes up? Not much. Not much. Now, I think, are starting to shift out of stage 6, okay? And this would be bear market territory for the stock market. And we have another chart that I can look at to kind of show that. But I think we are going to start heading over here, okay, in this area, stage 1, as we move into the beginning of 2023, whether it's full-blown in Q1 or Q2 of 2023, but I think stage 1 is the beginning of 2023. What goes down in stage 1? Stocks go down, commodities go down, but what goes up? Bonds, right here. This is your TLT right here going up. That's why the breakout in the TLT today was so gosh darn important, okay? Because it means we could be moving into stage 1, which means we are very close to entering that stage if we're not already in it, okay? So I think as we get to the beginning of 2021, this could become more substantial. All of that ground that TLT has lost, and let me just show you that perspective one more time before we move on from here. Look, from December of 2021, it has lost. And let me just scroll down over here to show you what it has lost. Over year to date, it's down 27.7%. That's a big drop. Year over year. So from December 1st, 2021 until today, December 1st, 2022, it's down 29.7%. TLT is about to make its move. In Q1 of 2023 into Q2 of 2023, I don't have a crystal ball, so I don't know the exact timing. But as we move into the first stage of the business market cycle, okay? As we move into the first stage, bonds go up. Stocks continue to go down. Stocks don't start going up until the market recession hits, until the market recession hits its bottom right here. And that would be stage 2. And that's when stocks and bonds are going up. So I hope this brings a little bit of clarity to what's happening with TLT, how badly it's been beaten up over the past year, and how its rally could have began in November of 2022. We may be underway, but this still needs to be back tested. A big 3% move, that's a big move. I would expect a pullback, a back test of this downsloping trend line before potentially saying, all right, I'm going to put my money over here because it's headed up. I hope that brings clarity to TLT, because I think it is about to be a pretty darn good winner. Now, going back to yields here, okay? Let me throw the 10-year back up on the screen here. Let's open it up a little bit. This was a big move today for the 10-year and the 2-year to pull back like it did. I mean, these were big moves, all right? And that was 2 days in a row, 2.8% down today, 3.6% down yesterday. Something shocking happened. With the 10-year dropping today by 2.8%, guess what didn't move like it should have? There has been this correlation all year. When the dollar goes down, stocks go up. When the dollar goes down, stocks go up. When the dollar goes up, stocks go down. When the 10-year has a big rate of change, whether up or down, it affects the Qs, the NASDAQ. It's affected. Now, this moving at the 10-year yield moving at 2.8% today was a big deal. But you would expect a big move like this would mean that the NASDAQ or the Qs would have had a big move too. But it did not. Okay? A 17 basis point drop in the 10-year should have caused the Qs and the NASDAQ to rise. Now, there could have been some reservations about the growth signaling from the abrupt drop in Treasury yields in play here. Now, a sharp slowdown in economic activity or the incoming recession is not a plus for earnings growth prospects. Accordingly, some underlying valuation angst may have acted as a resistance or a restraint for the stock market today too. Let's go look at the SPX for the S&P 500. I hope this is fascinating and interesting, and I hope you're able to follow along with me today. There's some big things that are about to happen. Big paradigm shifts. Okay, this is the SPX ticker, and it's for the S&P 500. Now, the main indices moved higher initially this morning after the latest reading for the PCE and core PCE price indexes showed a welcome moderation on the year-over-year basis. The upside momentum ran into a wall as the S&P 500 tested the 4,100 level, and participants digested the ISM release. But starting around 10:30 a.m., and these are Eastern times, the stock market clung to a narrow trading range around the S&P 500 tested a key technical level. Its 200-day moving average at 40.48. So, when I get my highlighter out here, this is the 200-day moving average right there. It tagged that later on in the day. Earlier, it tagged the upper end of the weekly expected move, and the wick broke through the down sloping trend line that has stopped every major rally in 2022. Now, let me clean this up a little bit so you can see it better. Now, that 200-day right there, it's a 200-day simple moving average at 40.48. That line of support was held, but it will be a key area to watch in the coming days. Market bulls will want to see it hold up, and preferably with support of heavy volume. Market bears, though, they will want to see the downsloping trend line that has stopped all significant rallies in 2020 to hold as resistance with heavy volume. We're starting to come to a gigantic inflection point as the battle lines are clearly drawn. Either bulls are taking us above 4,100, or the bears are taking us below 3,900. And anyone caught in between will be eaten up in the chop. What do you think? What do you think? Do you think that is what's going to happen? Can the bulls, can the momentum in the market break this downsloping trend line and break 4,100? Because remember, the upper end of the weekly expected move is 40.97. Okay? Just yesterday morning, we were at the lower end of the weekly expected move at 39.54. And with yesterday's rally and today's move, we're up there at the top now. 2 trading sessions, practically 1 trading session. And we were able to make it from one expected to the other weekly expected move. Incredible. Incredible volatility. Now, with this, we have to mention that the Fed's blackout period, because remember Wednesday, big move from Jerome Powell. What I heard were familiar phrases. His tone may have been a bit softer, and that's what got the market so excited. But whatever the case, the Fed's blackout period, where the Fed cannot say a word ahead of its next FOMC meeting, it starts on Saturday, this Saturday. So any corrections to the narrative from Fed Chair Powell's speech on Wednesday will need to be made tomorrow if Powell is at all concerned about how his tone and words have been digested by the market. If Fed Chair Powell thinks that the market rally was the wrong thing to do, that the market got the wrong idea from his Wednesday speech, then there will have to be a correction made tomorrow. However, if Powell says, okay, market, if you want to rally, that's good with me, then there will be silence. There will be silence. Now, there's also another very important question that's looming over the horizon. If bad news was good news over the past few months, for example, if poor economic data was seen as disinflationary and therefore better for the policy outlook, but now the Fed being openly talking or openly engaged with its slow down in rate hikes approach, will bad news become bad news going forward? Will poor economic data be taken as a sign of a closing window for the softish landing? I guess we'll have a chance tomorrow to find out. Tomorrow morning, to be precise, we get the November jobs report. A miss on the jobs report would seem to be a bull item according to the playbook that has defined the past few months, because it puts the Fed closer to a holding pattern where the Fed raises rates and then they stop and they hold. But what if we see a miss on jobs and then a failed upside move that closes well back under the bear market trend line, the down sloping trend line, especially if this happens on a weak dollar move? That could change the game for traders and introduce a new paradigm in terms of intermarket correlations. I don't know if I'm reaching you guys with this tonight, but we are on the verge of a potential shift. A potential shift in the market that has made this year so hard to trade, especially when we get into shop boxes like this right here, where we just move sideways, up, down, up, down, up, down, up, down. Who knows which way the market's going to go? Good news is bad news. Bad news is good news. Good news is good news. Bad news is bad news. Who knows? We should be getting clarity in the month of December. That's what I'm looking for. I am looking for clarity this month. With the Fed, is it going to 50 basis points at the next FOMC meeting on December 13th and 14th? Look at this. CME, Fed Watch Tool. You've seen me pull it up several times. Let's look at this real quick, because on Wednesday after Jerome Powell's speech, it moved, it changed, and today it's also changed. It's in flux, it's moving. Right here, the tallest bar on the screen, this is a 78.2% probability of a 50 basis point rate hike on December the 14th. December the 14th, that afternoon, is when Jerome Powell, he'll release a press release, and it'll have the rate hike on it. And then 30 minutes later, Jerome Powell will come out and give his press conference. There is currently a 21.8% probability of a 75 basis point rate hike. Now, let's look at the rate of change on these. 1 month ago, at the beginning of November, there was a 44.5% probability of a 50 basis point rate hike. Now it's a 78.2%. A month ago, at the beginning of November, there was a 49.7% probability of a 75 basis point rate hike in December. Now, as I told you, it's down to 21.8% probability of a 75 basis point rate hike at the December 14th in that afternoon. Now, hold on, not done here yet. Let's go look at February. Let's look at February, okay? February changed, and I'll tell you what the rate of change is here. This first bar, which is the highest, there's a 49.4% probability of a 25 basis point rate hike. That's right, 25 points. The middle bar at 42.6%, there is a 42.6% probability of a 50 basis point rate hike on February the 1st. That's the first meeting in 2023. And there's an 8% probability of a 75 basis point. But look at this, the rate of change. Looking at the 25 basis point rate hike, 1 month ago, at the beginning of November, it was 24.3% probability of a 25 basis point rate hike. Now it's up to 49.4% probability. The 50 basis point rate hike. 1 month ago, it was at 47%. It's now down to 42.6%. But the one that's moved, I think, the most, okay, that is the 75 basis point rate hike. 1 month ago, the beginning of November, there was a 25.8% probability of a 75 basis point rate hike on February the 1st, 2023. Now it's down to 8%. So clearly, Jerome Powell's message was received by the market to be a dovish and potentially a bullish catalyst. If Jerome Powell is happy with that, we will hear silence tomorrow, and there will be no hawkish news from the Fed before Saturday's start of their blackout period. Because remember, for several days leading up to their FOMC meeting, Fed officials are barred from speaking publicly. It's their blackout period. So if Jerome Powell wants to correct the narrative, this bullish narrative, he has tomorrow to do it. Otherwise, this market may just continue moving up. Or there's a paradigm shift, and all the correlations that we have had for the entirety of 2022 will break and be no more. I know this is a different take for a live stream. I get it from normal perspective here. All right, let me clean this chart up here a little bit. If you have questions, feel free to ask them. I'm sorry I didn't catch that one, Rebecca. Didn't the move happen yesterday in the Qs? Let me pull the Qs up. So there was a big move in the Qs yesterday. Yes. There was a big move in the 10-year yesterday. Yes. But there was a big move with the 10-year today also, meaning the Qs should have moved above the flat line. Okay? And let me just show you here real quick. I'm going to go to the 10-year. Okay? The 10-year. the highlighter. This was today's candle. It dropped 2.8%. Yesterday's candle, it dropped 3.6%, okay? Now, when we go back to the Qs, we should see two big green candles, but we don't. We have one big green candle in today's doji candle. Remember what a doji candle looked like. But where's my candlestick? Right here. So a doji candle is right here. There's barely any candle whatsoever. Okay. All right. So my point earlier about the 10-year moving, that rate of change should have caused the Qs, the NASDAQ, to also have a big rate of change. The big rate of change, the big rally in the NASDAQ and the Qs was yesterday, and there was a big rate of change in the 10-year yesterday coming down. But there was a big rate of change. The 10-year came down further today. But the Qs, the NASDAQ, didn't do it. It closed flat on the day. Look at the dollar here. Look at the dollar. It also had a big rate of change 1-2 days in a row. The markets should have rallied substantially today also because of the correlation. Because of the correlation that has been here for the entirety of 2022. So, something was off today. Something didn't add up right. So if there is going to be this paradigm shift, it's coming our way. Something is going to give. Look at this support line since the middle of October, okay? It started down here, middle of October. We've got plenty of tags right there. We've got 2 tags right there. This thing is going up right here, and it touches the downsloping trend line. Let me pull this down a little bit so you can see this. The downsloping trend line, let me move this for the 200-day moving average. The downsloping trend line is right here, okay? We are getting to this corner. The market is being backed into a corner. And if these correlations break, then we have a paradigm shift happening in the market where these correlations, they're broken. Is this what Jerome Powell wanted? Hike rates until something breaks? I think it means more than just correlations breaking. Okay. I'm new to investing. What would be a good long-term investment? If you're new to investing, like you say you are, the best thing that you can do right now is pick a simple big basket ETF, okay? If we haven't hit the bottom, because 2023, it could bring some pain, okay? It could bring a lot of pain, especially if we get the earnings recession in the first half of 2023. My suggestion, what I would do, being new, pick a big basket. You could go with the SPY, SPY, as the ticker symbol, and just start putting a little in there, a little in here, and start to accumulate. Then, once this bear market is over, continue to do the same thing as the bull market begins to take off. Right now is not the time to try to pick individual stocks. okay? Since the market is very volatile, meaning the market moves in big swings, up and down, trying to pick an individual stock is very, very difficult. So that would be my suggestion. Pick something that tracks the S&P 500, an ETF that tracks the S&P 500, VOO. Let me get my cursor back over here. VOO is a ticker symbol for the Vanguard S&P 500 ETF. You also have SPY, SPY, and that is an S&P 500 ETF. I would pick one of something that is tracks the S&P 500 and just start putting a little in every chance you get and go that route until we get out of this turmoil that we're in right now. Because this turmoil can really shake people out and cause them to lose money. We're in a bear market. And right now, we are in a very particular place. The last time we were in this place was the middle of August, and the market fell rapidly from this very place. In the middle of August, we tagged this trend line, and look at how far the market fell. We are at that same place right now, tagging that trend line. So we could be breaking down from here. Just dollar cost average into something that tracks the S&P 500. SPY, VOO, those are two good ones. Do good research once this market turns around, and then we can be more stock pickers, right? Now is not the time to do that because the market can move in incredible and it can move in ways that are not logical. So take a safe route for right now. That's what I would do. Let's see here. I don't want to miss anything. I think you guys are, I think you're next here. Let's see here. Let's say Jerome Powell does go soft and starts to pivot. I don't think he's going to pivot. Do you think inflation could start rising with the job market being so strong? I feel like the price wage spiral could become a problem if he does. There's no pivot, okay? Pivot means you're going one way and you're turning around going in a completely different direction. So I wouldn't use that word for what is happening. I do believe that the Fed, Jerome Powell, they are going to lower their pace of rate hikes. So we've been going 75 basis point, 75 basis point, 75 basis point. December 14th, we could go to a 50 basis point rate hike. And then February 1st, it could be a 50 basis point rate hike, or it could be a 25 basis point rate hike. So he's slowing down the pace at which rates are rising. The other piece of this is once they get to a point, they will stop raising rates and they will hold, okay? They will hold and they will not go anywhere. Once that point is reached, we're probably in a recession, okay? We're probably in a recession by the time the FOMC members, the voting members, decide to hold. Now, I don't know if a wage price spiral is likely at this point. It's always a probability, okay? But I don't think it's likely. I also think that inflation could start to tick back up a little. It could, as we get into 2023, if the Fed over tightens. It is possible. It's another probability. Is it possible? It is possible, I think, for inflation to start going back up a little bit in 2023. But is it going to be by a lot? I don't think so. Okay? At least from what I'm seeing at this moment in time, I don't think a wage-based spiral is likely. I don't think inflation going back up significantly is likely. I also, at the same time, I don't think inflation is going to go down significantly either. I think it becomes sticky somewhere between 3 and 4%. I mean, it's already sticky. Inflation is already high, but I don't think that it can go down much more than 3 to 4%. But as a base, I don't think it can go down past 3 or 4%. Okay. So, a soft, as in dovish, a soft landing. I'm not so sure we can do a soft landing because we're going into a recession. That seems to be a very high probability and likelihood. Tomorrow will be a very telling day with the jobs data and how the market reacts to the jobs data. Okay. It'll be very telling. And then if there's silence from the Fed, that will be very telling too. Okay. All right. Let's see here. What else here? Great info, Adam. Learning a lot. And yes, it seems like we have been at the top of the trend line for a long time. Yeah, it's almost like the market, okay, so expansion, contraction, that's how the market moves, right? So if we start right here when we bounced off this trend line here, we had expansion, we moved up, right? And then we had contraction where we just moved sideways. And it almost seemed like the market was scared to go test the downsloping trend line because everybody was watching it and everybody knew what would happen at that level. We'd get stomped off and we'd fall, or we'd get kicked off our rally pedestal and fall over. And we just went through another expansion move with yesterday. I mean, it just happened in a single day, but we had our expansion. And now we're sitting right at that trend line. Are we going to get knocked off our pedestal, and are we going to fall? And if we fall, can we get back below the 3,900 level? Or are bulls going to step in, forcing us to really come to a head when these two trend lines right here meet up at this point, probably around December the 12th or 13th is kind of like the tip of that point, right? Okay. So, and you are completely welcome. I'm glad I'm here and I can help. Awesome that you're from Canada. How's it going from America? Hope Canada's doing good up there. And you are very, very welcome. Thank you so very much as well. I greatly appreciate your time and attention here. That's wonderful. Okay. Let's see here. If you have any questions, plug them in now, because I am at the end of my notes. I do have one thing to add about tomorrow. As far as data that's coming out tomorrow, so you know what the expectations are of that data that comes out tomorrow. So I do have that I want to mention, but I want to make sure I'm getting your questions in as well. I was ready with puts yesterday. A very bad day for me. I didn't set a stop loss. That is a lesson that is a hard one to learn, a really hard one to learn. But I could almost promise that because of this mistake, you will be very cautious about setting stop losses in the future. I know when I first began trading, I was like, what's a stop loss? Why do I need that? I just can close out, right? Yeah, things can move fast, and it can move much faster than you paying attention to a chart. You've got maybe some other things to do during the day, and then boom, it happens. But it happens to all of us. It's happened to me before. It's a lesson that's hard to learn. Well, it's an easy one to learn. It's a hard one to suffer through. I'll put it that way, because it can be a rough one. But it'll get better with being able to set those. Okay. Any other questions, or are we good? Ready for me to just real quick go over the expectations for tomorrow? I'll clean this chart up, and if there's not another question, I'll go ahead and dive into that. It's just a couple things to look out for tomorrow, not a whole bunch. I just want to get these. Oops, not that one. I want to get the highlighters off of here, and then I can mention tomorrow for you. So, okay, let's do it. Looking ahead for tomorrow, which is Friday, December the 2nd, we've got the November jobs report. That is huge. We get non-farm payrolls. The expectation is 200,000. The prior reading was 261,000. Non-farm private payrolls, the expectation is 200,000. The prior reading was 233,000. We also get the unemployment rate. The expectation is 3.7%, and that's where it sits at this moment in time, 3.7%. So those are the big thing to watch out for is the employment situation. It comes out tomorrow morning before the market opens. How will the market react to that news? Are we going to get a paradigm shift where instead of bad news having bad reactions and good news having good reactions, are we going to trade something where bad news is good and good is bad? How is what Fed Chair Powell said on Wednesday going to affect how the market reacts to data? Today, it seemed like the market didn't know how to react to data. Economic data, that is. Let's got this right here. Let's say the CPI comes in cool. Where does this market go? It seems like this market just wants all-time highs now. It would seem that yes, the market just wants to go back to all-time highs. Sure. Especially when you look over at the Dow, right? When you look at the Dow, it's not that far off. And let me just adjust this real quick. It's not far off to think that, well, you know what? If things are good, the Dow, and I'm going to measure it to tell you exactly here, the Dow is about, let's get to that high point. It's about 6.5% away from all-time highs. Well, 52-week highs, which I believe it was its all-time high. 6.5%. That's not too far off. But the Dow today, while the SPX, the S&P 500, the SPY were flat, the Qs were up 0.1%. In my book, they should have been up a lot more, at least 0.5% or more. They were not. So nearly flat. The Dow being down 0.5% is interesting, right? But the Dow has also been on a super run, and it broke its downsloping trend line. It is now, though, in a bit of a struggle. It also broke its August high. Now, if we look here real carefully at where the Dow closed today, and I'm using ticker DIA for the Dow. If we go look back on August 16th, the high was the high was 343. Where did we close today? 344. $1 above the high from August 16th of this year, okay? So breaking through that high yesterday, well, actually it did it a few days ago, just barely, but really broke through it yesterday, pulling back to that point. Could that be support for the Dow now? So seeing the Dow get there isn't that far off. But if we look at the SPY and especially the Qs, they are a ways off from getting back to those highs. Look at the SPY here for the S&P 500, okay? If I go and measure where we closed and where we're at, about right there, just a few pennies above it, and then go mark off the all-time high, that's 17.4%. So 6.5% versus about 17.5%. That's a big difference. And then if you look at the Qs are even worse. Okay, let's go to where they closed today, right about there, 293, and then go up to the Qs high. And this is a shocker because it's so far off. Nearly 40%. So 6.5% for DIA or the Dow, 17.5% for the S&P 500, but nearly 40% for the NASDAQ. The NASDAQ is way off, and it's not even touching or close to its downsloping trend line that has turned every major rally into ashes and sent them down lower this year. So the Qs are a big one. But if CPI cools off, but again, I think CPI has trouble once it gets to 4%. Once inflation gets down to 4%, I think there's going to be some problem. At least that's what I'm thinking right now. That 4% is going to be a problem area for inflation coming down. Now, the Qs, they have a lot of room. They could move. They're still in bear market territory. For the S&P 500, it's a little more there, but still, it's like stuck in between the Qs and the DIA, or the NASDAQ and the Dow Jones. But as we go into a recession, right, the components making up the Dow are going to suffer a little bit more, as they do in a recession. Dow Jones Industrial Average. Industrials take a back seat. I don't know if is it listed? I don't think it's back here. But if we just look at commodities, for example, commodities, they fall in stage 1. Commodities fall in stage 2. Now, you need these commodities, the metals especially, for the industrials. And then the industrials, the transportations need the industrials. Look at Dow theory. Just type it in, Dow theory, and read about it for a moment. it talks about transportation versus industrials, and it's a fun little exercise to go through Dow theory and learn about it if you haven't already. But it can give you some insight into what's going on. So once we reach the bottom for the recession, okay, and once we start coming out of the recession, and I should probably use a different color than red, that's when commodities start going up, okay? And you need commodities, your metals and everything else on the periodic table to start building things again, and then start shipping them and start taking them to the end consumer. So I think the Dow is going to, I'm not sure why it's taking off like it is right now, because we should be exiting stage 6 of the cycle, and we should be entering stage 1 here really soon. And remember, stage 1 is when bonds go up, stocks and commodities, they continue to go down. All right. So the stock market hasn't seen its bottom yet. Even if the S&P 500 does break the downsloping trend line, that's fine. It's all dandy, because we're going to reach a point where we're coming back down again. Okay. Let's see here. Also, I don't want to miss or mix these up here. Also, would you trim your portfolio in some stocks with this rally? I would, yes. Yes. Remember, when it comes to trading, trade with small parts of your portfolio, small position sizes. If you are still holding, actually, there's a question to ask here with your portfolio. I don't know what's in it or how it's been performing or what. If you have losses and you want to cut those losses, there is such thing as, tax harvesting or tax loss harvesting, to write off those losses to your gains that you have made with trading. But talk to an accountant about that. Now is the time of year when that starts happening. So stocks that have done poorly this year, they could have a real fallout this month because of tax loss harvesting. Okay. And that could also play into the markets falling instead of getting the Santa Claus rally. Okay. So talk to your accountant about how to do that. But if your portfolio, either you're not down much because of this rally, or even you've made a gain, I would trim at this stage. Okay. But again, not financial advice, just something that I would do if I was holding. I know it's not a perfect answer there, because I don't know the ins and outs of your portfolio. Let's see here. I want to make sure I get these right. I kind of went crazy buying the dip October and September. Now I'm up big on almost. Okay, well, see, it's tough to answer these type of questions. I mean, you're up big. So if, September and October, I mean, that's like, well, okay, hold on. Let me get my highlighter. So September and October, that's like this part of the market. If you bought then, I would most likely still hold. Okay. If I bought in this circle right here, which is September and October, let's say September 1st all the way through to November the 1st. If I bought somewhere within that circle, and those dates may be a little bit too wide, I would probably hold. Okay. If I wanted to trim some that have gone just crazy and have gone up big time, I would probably trim some of those, maybe take a third off the table, see how the market reacts now that it's at this trend line here. Can it break above 4,100? If it does, hold it a little bit longer. And then if it turns, then take another third. There's so many strategies here. But if I bought in that circle in October or September, I would most likely hold. Okay. Especially if it's companies that I want to hold for the long term. And I guess that's the real guide here. If you want to hold this company for the next 5, 10, 15, 20, 50 years, I would hold it. Buying at that point, I would hold. I would not sell it. I would not let go. But if there are companies that you bought, they had a great run, and you don't really care about the company or what it does, and you're not planning on holding it for a long time, then those would be the ones that I would start trimming. Yes. I think that would be I think that's a clearer answer. Okay. Let's see here. LOL, the NASDAQ has barely moved. Yeah. Isn't that the truth? Being down nearly 40%, while the Dow Jones, or being down 40% from its all-time high compared to the Dow Jones being only about 6.5%, that is definitely something. Hypothetical question. If that rail strike would have happened, do you think the market would have wrecked? Yes. Just think about how many products are moved by rail. And I'm not just talking about retail products. I'm talking about products that industry uses. How much gas, propane, coal, natural resources are shipped by train. That would have been a disaster for our economy, a complete and total disaster for our economy. That's why Congress had to act. That's how serious a threat that was to our economy. So I'm glad Congress acted, and I truly hope it prevents the strike. I hope the president signs it, and let's move on. We don't need to be arguing and fighting against each other. We need to be working together no matter what. There's too many negative things out there. Internally, we need to be together, on the same page, working for a common goal. So I love the hypotheticals. They're fun to think about. They're good brain exercise to get your gears turning. All right. Anything else before we wrap it up for tonight? And I'll see you guys tomorrow. Real quick, though, if you could do me a favor, click that like button, share this video with your friend. And if you like the perspective, click the first link in the description. Those things help out greatly and allow me to do these live streams. I love them. Absolutely love them. I love your questions too. They're awesome. Okay, I'll give you a minute or so. I'm done. Thanks. You are welcome. And I do apologize. Sorry I missed you guys yesterday. I just had a headache come on, and it was a nasty one. And you know, with the light shining, I just couldn't get in front of the camera here to do the live stream yesterday. So I do apologize for missing you guys yesterday. It was a big one. And just to mention too, with yesterday's rally, I was going short. The further yesterday went up, I was buying some puts as we got close to that trend line. I'm still holding them. I did not let go of any. So I do have some short positions opened at this moment in time, just to let you guys know. All right. Awesome. I am super glad. Okay. Everyone is getting sick. Yeah, we had a cold go through the house, a sickness go through the house. My gosh, it seemed to last for weeks and weeks and weeks. I'm just glad I didn't come down with a real bad case. My kids did. You know, everyone else they got it, but I didn't get it too bad, thank goodness. All right, well, we'll wrap it up here. I'll be back tomorrow after the market is closed to talk about what happened, why it happened, and what to expect going forward. Hopefully, we get some clarity in the month of December. That's my wish to Santa Claus. Some clarity in the month of December. I think we'll get some. I really do. Especially being at this downsloping trend line, the 200-day, 4,100 and 3,900. How are we going to interact? What's the chemistry going to be? Where are we going next? Hopefully we get some clarity. That's my phrase for December. Let's get some clarity, okay? All right. You guys have a wonderful, wonderful evening and night. I will see you tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. And remember, jobs data comes out tomorrow. Watch how the market reacts to it. And also be on the lookout for any Fed speak, okay? We need to know whether it's positive or negative. What's with that? Is it quiet, or does something hawkish come out and, you know, grab that fish with its talons and start flying up again, if hawks even do that? All right. Have a wonderful evening. I'll see you in the next video. Take care.